So we're back for another episode of Mortgage Terms That Sound Made Up but Are Probably Real. And this week's episode is about something called the Mortgage Credit Certificate. So we have Patty Gonzalez from the Community Investment Corporation, the Director of Housing, I understand.
Yes.
So Mortgage Credit Certificate, MCC, real?
Real.
Okay.
And I know it's going to sound hard to believe because it's been around for a very long, since 1991.
1991.
And I've been administering it since 1995. So it's kind of like my baby.
Wow. Yeah. So you've got a few years of experience doing this.
Still few.
So Mortgage Credit Certificate, can you walk us through the basics of that?
So the MCC, Mortgage Credit Certificate, is a tax credit program. So anyone purchasing a home and are paying interest on their mortgage, they'll get 40% of the interest they pay up to $2,000. So most people are capped at $2,000. So it's a $2,000 tax credit for the life of the mortgage. So once they're in their home and start making that mortgage payment, they'll start seeing this $2,000 tax credit.
And the tax credit, that's something that I think is very confusing, especially for people like me that aren't always in the tax world. We have all kinds of tax incentives, and there's deductions and credits. This is different than what people refer to as the mortgage deduction that they might take on their taxes.
Correct, which gets mistaken quite often. Even our tax preparers will let our homeowners, once they have a certificate, say, oh, we're not putting your house on your taxes because we're not itemizing the interest you're paying as a deduction. It's a different subject. It's an actual tax credit. So, of course, we all know anyone that purchases a home can write off their interest as a deduction, but most don't anymore because of the standard deduction IRS gives us. And so this credit is an addition to that. So
if you're getting, let's say if you were getting, without the mortgage credit certificate, if you were getting a refund of $1,000, you would just get a refund of $3,000.
$3,000, correct.
And if you owe taxes, that liability be reduced by that, whatever you qualify for.
That's exactly right.
Okay. So I hate to do this on video, but we need to do a little math.
Okay.
Because you threw out some numbers and we threw out percentages. 40% of the interest paid. So right now, interest rates are higher than they have been in the past. So if we're talking 6 to 7% interest rates on a $100,000 loan, I mean, that's like $6,000, $7,000 worth of interest.
Correct.
And then it's up to 40% of that?
It's 40% of that up to $2,000.
Up to $2,000. Okay.
Yeah. Okay. So for my math purposes, it's $125,000 at 4% interest. They're going to pay $5,000 in just interest alone.
Okay.
40% of that, 40% of the $5,000 is $2,000. So
okay.
As long as their loan amount is over $125,000 and their interest is over 4%, they'll be capped at the $2,000.
Okay. And then that every year, because you owe a little bit less, so you pay slightly less interest. It's the same calculation. And because it's capped at 40%, you're probably going to get that for 10, 15 years probably.
On average, we just had our 30-year anniversary, and for at least the first 20 years, people are getting they're capped at the $2,000. Wow. So over the life of the 30 years, on average, people are seeing $50,000 worth of tax credits.
Oh my gosh, that's pretty good.
Yeah.
So there's got to be a catch. What's the catch?
The catch is that you should apply prior to closing, and people don't know the program exists.
Okay.
So the big thing is, why didn't I know about it? Or I want the tax credit. Because
this isn't done through us. I'm a mortgage lender. This is not done through us. We have to let people know about this so they can come see you, because you're an independent agency that oversees this program.
Correct. So we're a local nonprofit, and we administer the program for the entire state. And we're the gatekeeper. You're the only way to get into this tax credit program. And there's probably 4 other states that do it in all the United States. So it's not offered everywhere.
I thought every state had it.
No, it's not offered everywhere. And the
things I learned hanging out with these cool people. That's awesome.
Yeah, we've only been doing this since 99.
And is it available? Because there was a while it was only available like in certain zip codes or certain areas.
It's always been available in Pima County. It was statewide in the 90s, and then Maricopa had pulled out, and in the last 2 years, Maricopa's back in. So now it's been statewide for the last 5 years or so.
Okay. And I know there's some qualifications, so we should probably get that out there too.
The main one is you have to be a first-time home buyer or not owned a home in the last 3 years, or you have to at least have been renting in the last 3 years. So we have a lot of I'm on my mom's title but I never lived there. I never had ownership interest. It's just in case something happens. As long as you've not lived there in the last 3 years, you're considered a first-time home buyer.
Okay.
Or if you're a veteran or buying what's considered a target area, which is certain census tracts, you do not have to be a first-time home buyer. Okay. So that's kind of the first obstacle. And then there's income limits based off your family size and purchase price limits.
And those income limits, are those in place across the board, or are there like exceptions for military or census?
So if the income limit, if they're in a target area, that same census tract, the income limits are higher, and so are the purchase price limits. So that's another benefit of buying in a target area. You don't have to be a first-time buyer, and income and price limits are higher for target areas.
And how do they, if someone wanted to actively search for homes in a specific area, do you have that list?
We actually have a very friendly map on our website, and it's the whole state. It's shaded, and it's green or teal. If it's green, it's not target. It's teal. It's target, so that way people can zoom in. Otherwise, there's a line there where you just put that address, and then you'll find out if it's in a target area or not.
Okay.
But the non-target areas are pretty generous. You know, you're looking at $100,000 limit, 105 for a family of 3 or more income limit, and your purchase price limits are, I think, closer to $500,000 now. So most people don't have problems.
That's changed a lot.
It has.
When I first started doing MCCs like 15 years ago, when I found out about them, the income limit was like $30,000, and there it was a much more narrow qualifying population.
Yep. No, we're definitely utilizing the program. It's always been funded. It's never run out of program money. And then we've actually, over the life of since 91, we've done over 9,000, issued 9,000 certificates. So
1,000 times 50,000, that's a lot of money.
It's a lot of tax credits. Yeah.
And from a procedural standpoint, they will come to me. If I see that they qualify, I'll refer them over to CIC, and you have documentation requirements just like we do.
Correct.
What kind of documentation should they be prepared to provide?
For us, we'll need from you the loan application, so your standard form. But
I have to do work?
You have to submit a form.
Never mind. This interview is over.
I know.
I thought you were doing all the work.
I thought, they want their $50,000. You're going to have to do a little bit of work.
I'll help out.
Yeah. And there are 3 years of tax returns, 3 years of income tax returns, the federal 1040. That's the main thing they want to start gathering. Okay. I know you guys are required to collect that anymore. They can order them if they don't have them from IRS, get transcripts. But what we're looking for on those is that we're looking at income limits. We also will take the time and show them on their tax return the difference between deductions and credits and where that refund's going to kick in. And if they're going to be getting a big refund, we could also show them where they can adjust their withholdings so they take more money home per paycheck. Okay. Which is going to help make their mortgage payment a little easier. And
there are people that don't always have to file taxes or income? Would they be considered for this program, or does it make sense?
No, they still can apply. And if for some reason they did not file, it's not required to turn in because they did not file.
Okay.
But a lot of people either didn't make enough money to file, or right now your younger generation is being claimed by their parents still, or you have someone that may have been on disability, and most people tend to go back to work, have some kind of taxable income, or they get in filing jointly with somebody that has taxable income.
So you're looking at it from a qualifying standpoint, but also a benefit standpoint, because if there's no benefit to them for whatever reason, they don't need to go through the process.
Correct. But most people, we have found that, unless, I'm 85 and I'm living out of Social Security and I'm buying a house, then I'm probably not going to go back to work and start filing taxes. But most people tend to get qualified.
Okay. And then I know there are fees involved.
There is a one-time program fee to get into the program. So there's a $500 fee, and that's something that it can be collected at closing. It's considered a closing cost.
Okay.
Or the buyer can, once they move into a home, they can start making payments on that. We'll take payments through the end of every year because we want to make sure they paid it off by January so they can start filing their tax returns.
Oh, okay.
Yeah.
So you're trying to remove a lot of obstacles and hurdles.
We want to stay out of the closing process as much as possible. So, so that's another issue that we find is because this tax credit program doesn't really have anything to do with the buying process. And so we're overwhelmed with the buying process, and it's already a lot of information, and to throw a tax credit at them, gets a little confusing. So we try to stay out of the closing process, work with them, show them on their tax returns. And then once they're in the program, our goal is just to get them in the program, because then in January, that's when we start working with them offering free tax preparation and be like, we want to make sure you guys utilize the program.
And then they have to renew it every year. It's not automatic, right? They have to go in and physically say, I want to renew this.
So we will send them, there's actually a renewal fee.
Okay.
And every January we send them, here's the tax form. This is how you claim it. If you're doing TurboTax, have your tax preparer call us, come in for free tax preparation. And we do all that in January. And then that renewal fee is usually due in April once tax returns are due. Because if they didn't benefit from the program, they don't pay that renewal fee. The renewal fee is waived. So it's a case by case.
And is it another $500?
It's $100.
Okay.
Yeah.
So you're only getting $1,900 benefit from this program. See how it is?
Correct. Yes.
I see how it is. It's always in the fine print. People.
It is, but you know what? We file their income tax returns,
Now it's back over.
Yeah.
And a lot of people that are purchasing homes right now, as we're sitting here in 2023, their expectation is that rates are going to drop and they're going to refinance. Do they lose their credit when they refinance?
They do not. They actually will let us know that they've refinanced. We collect one of their documents from their closing and we transfer it over. So they don't requalify. We don't have to get anything from the lender. It's just
nice.
Yeah.
Okay, now this is starting to make more sense for me.
So yeah, we just work directly with them and be like, okay, we're going to transfer this over because the certificate is good for the original 30 years. So, they can refinance 6 times and, be spreading out the term, but the certificate will still expire after the 30.
If they purchase a new home, then obviously they wouldn't be first-time home buyers. So if they turn this current home into a rental, would they still be able to use that incentive?
They cannot. It's supposed to be their primary residence.
Okay. Mm-hmm. So, it sounds like you're hitting a very specific target and you've really kind of thought through all of the different connections to that. So it's helping a first-time home buyer or veteran. It's giving a little bit of a benefit if you're looking for homes in a certain area that are designated as target areas. Mm-hmm. And it's also kind of, you avoid manipulation by having someone then turn it into a rental immediately and
correct. Yeah. And $2,000 every year, it's, even if you use it to pay down your principal, mm-hmm. You're still going to see that credit for the first 20 years regardless. So, we understand that the credit goes away if you're buying them, paying down that interest, but you're still going to utilize a lot of money in those first, 15, 20 years.
So if you're a first-time home buyer or a veteran, ask your lender if they're familiar with the mortgage credit certificate and they can help you through that process. If not, you can reach out to Patty's team over at the Community Investment Corporation. And if we do things properly, somewhere here, there's a website. You can find her. We'll see how that old technology works out on that. And also, you might also talk to your lender, too, because this not something we're going to get into in today's video, but that $2,000 can be used towards qualifying income on some programs.
Big secret. Yeah, you can do a lot with $2,000. Yeah, we're talking about that in another session.
Well, I think we've given them enough for today, but
awesome.
But definitely talk to your lender, especially if you're what they refer to as your debt to income ratio. They say it's a little too tight. If you qualify for the mortgage credit certificate, we've had people that makes the difference between whether they can purchase a home or not.
Mm-hmm. Especially with today's rates, you qualified at 6, but not at 7.5. Still make it work.
Patty Gonzalez, Director of Housing for the Community Investment Corporation, a Tucson nonprofit serving all of Arizona. Yeah. And we're appreciative of your time. I know you're quite busy these days.
Well, I'm glad you had me here. It's nice to see you guys again.